Good morning, everybody, and welcome to the Woolen Mortgage Team's Monday Morning Mortgage Message. I am Sean Woolen, your host, and today is going to kind of knock out what's going on with the markets right now, where interest rates are, why they're going up. Hopefully they'll come down, and we'll kind of talk about that as well, and kind of get into the inflationary issues that we have been facing for the last year. So I'm going to, without further ado, I'm going to just go ahead and get after it this morning. So rates, real estate, and recession, like what in the heck is happening with mortgage rates? Let's get into that right now. I'm going to go ahead and share my screen, and then we will get right into it here. So bear with me as I start here. Rates, real estate, and recession. So rates, I thought this was appropriate. Up, and away, good old Superman. We have screamed higher from rates in the 2s to rates into the 7s in a very, very short period of time. It's been rough to watch. And you and I both have seen the impacts of what that can do on our customers, on just the psychology of the market today. It's just different. So let's see what happens. But here's something that I have going on right now. If anyone buys right now, I want to take the fear of buying in a high interest rate environment away. And I'll give you some data as to why I believe rates will come down in the near future and how this is going to be a great thing for you to offer your customers. So 0 lender fees on any refinance. So buy now, refi later. Any purchase transaction in the next year through December of next year, I will offer a free refinance. That means no lender fees on any refinance after that. So just remember that when you're talking to customers, say, hey, I have a friend that if you do the loan with them, they will refinance as soon as rates drop. They will refinance you into a lower rate for no lender fees. So this should help a little bit take the pain out of where rates are right now. So let's look at rates. Let's see what is really happening with interest rates right now. So I'm going to share this right here. And what do we have here? We are positive for the day. We are up 11 basis points for the day. But what is happening overall? It's very volatile, guys. When I say very volatile, look at what's happening today. This is just today. We were up almost 20 basis points early morning. Then we were negative. And then we were up almost 20 basis points, 15 basis points again. And then negative 15. That's a 30 basis point swing. That's about an 1/8 to 1/4 in rate right there. And then we were flat. And then we were down 25 basis points. And then we're up 15 basis points, and then we were down negative 38 basis points, and now we're somewhat neutral and positive. Like scratching my head, like what do we do when we say when should we lock? How do you gauge it in a market like this? And the answer is let's focus on what the trends are, and we'll go over that in a bit, and then discuss different locking strategies as well. So where are we with interest rates overall? This is the Mortgage News Daily. I always like to share this. This is a great way of presenting to your customers where rates truly are. There are some really bad advertisements, I guess you could say, where they're showing rates in the 5s on a 30-year fix, but it costs like 4 points to get them. So this is a good industry standard. Mortgage News Daily, they have a daily rate ranking of what's happening. This is based on Friday, 7.32, the average 30-year fixed. 15, we're at 666. Hello, Halloween. You're right around the corner. Spooky season, that fits really well. 30-year jumbo, 6 1/4. Always a little bit better on jumbo right now. It's just interesting how that works. 5-year ARM, we're in the, it's 6 3/4. There's a savings there, so we'll talk about that. FHA is still in the 6s, and 30-year VA is still in the 6s. So look at that chart of what's happening. That spike, oh, that's hard to watch. But that's the reality behind it, guys. It is volatile. And what is causing that? And the answer is inflation. Inflation is just too many dollars entering and chasing after too few of goods. So we saw that. We had a lot of money in the markets, and then we had supply chain issues, right? So too much money, too much stimulus, too much money pouring in our markets led to people fighting over goods, paying more for it, et cetera, et cetera. So the Fed is going to hike the rates, slow down borrowing, slow down the money, and hopefully have a supply chain help, which means people put more money in the bank. And here we go, more supply, less money, should bring down inflation. So now, inflation and mortgage rates. This is a really good breakdown of what you see: inflation and mortgage rates side by side. They mirror each other. When inflation goes up, mortgages go up. When inflation goes up, mortgages go up. When inflation comes down, mortgages come down. An anomaly right here, we saw inflation go up, and then it was lagging because rates were still dropping. It was lagging, and then it caught up with itself. And the spending started down here, quantitative easing, flooding the market with money, boom, inflation. And you've seen where it's gone. So mortgage rates go up with inflation. When inflation goes up, mortgage rates follow. It's a really good indication of what's going to happen with interest rates. So if you watch anything on what's happening with mortgage rates, just watch inflation. So when inflation comes down, mortgage rates will come down as well. But when will it peak? When will mortgage rates and inflation peak? We replaced big numbers with low numbers back here. So June, we saw a little bit, oh, yay, rates came down a little because this was a year ago, June was high, July was low, August was low, September was low. So we replaced these numbers with bigger numbers, and we saw a spike in the unemployment. But these are the inflation. These are the inflation numbers that we have moving forward that we're going to be replacing with new data. So if we get a lower than 0.6% per month, month over month for October, if it comes in at 0.3, overall CPI inflation will come down, which means rates will come down. And if we replace all these big numbers with lower numbers moving forward, hopefully we'll see mortgage rates come down as well. So that's what everyone is hoping on. The Feds are really acting very aggressive to make sure that happens. So let's see what they do. But this is what our Fed said about inflation. This is good old Powell. We now understand how little we understand about inflation. This was literally last couple months. He said this. We now understand how little we understand about inflation. Does that give you a lot of confidence? Not me, but hey, he's in charge, and let's hope that he's figured things out a little bit. So Fed hikes. If anyone asks you or thinks that there's not going to be a recession, look at this. Fed hikes is the line. The recession is the vertical shaded light blue. So way back in the day, Fed hikes, recession. 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 Fed hikes, guess what? Recession. Check this out. This is fun. Mrs. Mester, they said, we have not seen any progress, or she said, any progress on inflation. And so I think we need to bring interest rates up through this year and a little bit into next year. Now, this is just recent. This is October 11th. She said this. Monetary policy will need to become more restrictive in order to put inflation on a sustainable downward path, which means inflation down, rates down, mortgage rates. Keep that in mind. But let's just look and peek what they said before this. Back in April, this is not too long ago, guys. She said, I am unconcerned with inflation running away from us. Then, I'm not worried about inflation getting out of control. And then, the Feds need inflation expectations and real inflation to rise. She said, we need it to rise. Like, really? And then she said, by the end of the year, I expect inflation to be between 3.5 and 4, with a drop in 2022. Well, that was a joke, because we all know what happened. So I want to talk to you about the inverted yield curve. This is a normal yield curve. This is where short-term money is cheaper or less of a yield than long-term money. We all know that we invest in a 12-month CD, we're going to get less of a return than a 3-year CD, right? Well, not anymore. We are now inverted. That means short-term money makes more than long-term money. That's not a good sign, and it always shows inflation or recession is coming. So here's where we are now. Short-term money on the left, long-term money on the right. It is, you make more money on short-term than long-term money. Here's what it shows. Inversions always lead to recessions. Inverted yield curve, recession is in the shade. Inverted yield curve, recession. 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 Inverted yield curve, what's happening next? Recession. It's just the way it works. And this is our Feds again. I don't know why they're in charge, but they are, so we have to live with it. This guy says, I can't see a recession with a 3.5% unemployment rate. So he doesn't believe we can have a recession when unemployment is so low. Let's have a look at history. On the left-hand side, this graph is the unemployment rate. The shaded is recession. Let's see when unemployment rate goes up. Unemployment rate down here is really low. And then we had a recession. So unemployment was low, and then we had a recession. Well, he just said, I can't see a recession coming with a 3.5% unemployment rate. Well, unemployment rate was really low, and then a recession, and then unemployment rate was higher after the recession was over. Unemployment rate low, recession. Higher unemployment rate after. Low unemployment rate, recession. Higher unemployment rate after. And on and on and on and on and on and on and on. I mean, low unemployment rate, recession. High unemployment rate after the recession was over. So this is just how it works. So for our Fed people to say, I can't see a recession with a 3.5% unemployment rate, they're not seeing the forest through the trees at all. So unemployment rate is a lagging indicator. When a recession starts, that's when people start laying off employees. They don't do it before when things are good. They do it after, and they try to hold on to those employees as long as possible, and then they're forced to cut. That's why unemployment is a lagging indicator of a recession. You're always going to have low unemployment before a recession. So I can't believe they said that. It still makes me scratch my head. So this is our Fed chair saying there's going to be a soft landing as we go over Niagara Falls. Let's hope that he's alive at the bottom and our economy is as well, because it's going to be a interesting drop. So they're going to raise another 3/4 this next Fed meeting, and they're teetering on 50 basis points and not another 3/4 on the next meeting after that. So let's see what happens. So mortgage rates and recessions. I want to give you guys hope, because mortgage rates always come down during recessions. So look at these recessions. Mortgage rates were high, there was a recession, they came down. Mortgage rates were high, there was a recession, they came down. Mortgage rates were higher, there was a recession, they came down. Mortgage rates were higher, there was a recession, mortgage rates came down. Recession, down. Recession, down. Let's look at the percentages. 3.75 to 2.75. That's 30%. Next one, 6 to 4.875. The other one, 7 3/8 to 6.75. 11 to 8.75. We had 18 to 13. We had 16 to 11 3/4. So that's a good sign. You know what that means, guys? Rates will come down because we are in a recession. So 0-point loans, I'm not going to get into this in detail because it's a little long-winded and I kind of got a little bit convoluted. But basically, when you know rates are going to be better in the future, you don't want your customers paying points on their own to get a lower rate, because if they refinance within 6 to 12 months, it's a waste of money. So we can look over it on their individual basis, but if the seller's paying for it and it really helps the consumer get into a much better payment to qualify, and they want to buy now, and it benefits them right now, and the seller's paying for it, it may be worthwhile. But coming out of pocket on their own, I say it doesn't make sense right now. We can talk about these individual strategies with your customers. But if they're paying for it themselves, I say no points right now. 0 points loans is what we want to do. So let's change your focus. All we're seeing is negative in the markets. When I say the markets, I mean the media. Let's just face it, the media is bonkers. I'll prove it in a minute. We need to be educators to our consumers, to our borrowers, to our buyers. We need to educate them on what reality is and help them understand the markets to get over the weird fears that are out there. So here's a little bit of information on what housing does during a recession. Housing is the white line, recession is the dark shaded line. A small gradual decrease here, increase in, and this is through housing values. We had an increase in values here, increase in values here, increase in values here, increase in values, increase in values, increase in values. We had one anomaly where the mortgage industry decided to get drunk and offer loans that didn't make sense and then package them up and sell them as AAA paper, right? We all saw that happen when they were doing 2-year adjustable rate mortgages where the caps on the adjustments were ridiculous. They could go up dramatically, but they had 3-year prepays on them. So when they did adjust, people weren't allowed to refinance them and get out of them. Drunk. I'm just saying, bad loans. You could breathe on a mirror and get a loan. That caused this issue. That caused this housing financial crisis. So this is an anomaly, but that's what everyone remembers. Another one here, recession and increase. So recessions typically bring about positive growth. Mind you, not astronomically up higher in values, but they do cause positive values or values to increase still. So let's look at housing growth, because we have households, humans needing houses to live in, and we have growth exponentially getting higher, and the amount of people and annual completions from builders going lower. And it's a problem. Let's look back in 2006. The annual completions of homes was way higher than the growth of households. Over inventory leads to people lowering their prices to sell the home. Too much home, not enough. Too many homes, not enough buyers or households growing to get them. And now look, we have households growing and not enough growth. Look at this pattern. So we had builders slowed down, but growth continued exponentially. And we have one of the biggest groups of people growing in the biggest buyer pool with the millennials in a long time. So we have households growing and not enough houses being built, and that's a problem. So here's the generational growth. Look at the millennial growth compared to our Gen X. That's me back here. We are quite a bit higher, but our overall completions is lower. So we're going to have an inventory problem to keep moving forward. And we're going to continue to have corporations buying properties for rentals. So yes, we will continue to have inventory issues because of this. A huge drop in formations of homes and a huge completion of homes leads to problems. But we are over here, guys. We need homes for these households and not enough homes being built. And builder sentiment, guys, last week was at a low of a 32. I believe there was a factor. 50 or above is good. Anything below that is bad. That means starts and builders are slowing down. And as households growth, that's going to lead to an inventory shortage. But Diana Olick, we love her. We see her on the news. She is the fear factor 101. She is the scariest person in real estate because she scares everyone out of doing anything in real estate. She's perfect for Halloween. She scares people away from buying. But let's see what scary things she said and what reality was over the past, let's just say 10 years. Let's go back. So we'll go back to 2015. She said, and I quote, "A bubble larger than 2006 is happening right now in 2015. She said this. That's a quote. Thank you, Diana. Next year, 2016, we're in a new housing bubble. We saw 5.4% growth that year. 2017, home ownership doesn't build wealth, study finds. Really? It grew 6% that year. 2018, it's better to rent than to buy. Oh yeah, we grew 4% that year. July 2019, the housing market is about to shift in bad way for buyers. Really? We saw 4% appreciation that year. 2020, next year will be hard on the housing market, especially in these big cities. And she went on to say Phoenix, LA, New York, like 16% growth that year. I mean, can she get it right? 2021, housing boom is over as new home sales fall to pandemic lows. Really, 18% that year. So if you want to be scared out of ever buying, just watch Diana Olick on the news. It's just crazy. But look at the inventory, guys. We're currently on a 1.28 million homes in current inventory as of this last quarter. Now, look at the month before that, we were lower. I'll get into that in a minute. But look at the peak we were at way up here when the market was trash. 2.5 is the average. If you include that, we're way below that. But the amount of homes that are going under contract, the percentage is significantly higher right now. Let's look at that. Here's a trend showing where we're at. We're actually coming down on inventory right now. I'll go over that in just a little bit. But here it is. Here's the seesaw, the ridgeback of a dinosaur that we like to see. This is the seasonal movement for our real estate market in this nation every year. We see low inventory, high inventory, low inventory, high inventory, just back and forth, back and forth. It's like clockwork, guys. And what do all of us do down here? We panic. Oh my gosh, it's slowing down. I need to spend tens of thousands of dollars on leads. Oh my goodness, it's panicking. And every month it comes back up. Down, up, down, up, down, up, down, up. And now guess what we're going to do, guys? Inventory is it's peaking and it's going to come down. So existing home inventory is the real story, guys. We're at 1.28 million right now. Under contract, off the market, based on those numbers, 553,000 of those homes are under contract. That means in reality, there's only active listing. What's left, 727,000 homes nationally. That's 43% under contract. The average is 25%. So the amount of homes selling relative to what's listed is significantly higher right now than average. That means people are still buying, regardless of rates. They are still buying. Is it more challenging? It is a little bit more challenging because a lot of those first-time home buyers are frustrated, but the amount of homes still selling and going into contract, the percentage is quite high. Inventory is going to come back down based on normal trends. And here's one that I love. This was just in the magazines in July. Dramatic increase, dramatic. Foreclosure filings are up more than 150%. So as a consumer, we read this and say, wow, maybe I can take advantage of buying a foreclosure. Maybe there's going to be a ton of foreclosures and the market's going to drop, right? That's what a consumer would think. Well, let's look at the numbers because this is just statistics 101. You can make anything look the way you want it, right? So if you have one foreclosure, and it goes up 1,000%, we are at a still very, very low percent of foreclosures. We are at 10, right? So let me just rephrase this. This is where we're at right now, this dramatic increase. We had a foreclosure moratorium. There was no foreclosures being done. People got a free pass. And there were still 65,000 foreclosures in 2021. There was no foreclosures happening and there were still 65,000. So they had a free pass, but they still foreclosed, right? We went up to 164 and they're saying it's a dramatic increase. We're at the same as 2020. We're below 2019. We're way below 2018 normal markets. And look at this trend lower in foreclosures. So is this dramatic? Well, yeah. If you consider like where we were with none, it's just statistics, guys. The news likes to freak people out. So when you see stuff like this, we need to educate our buyers. Yeah, they're up compared to where there were no foreclosures during the foreclosure moratorium, but we're still well below normal. All right. So they're not going to be tons of foreclosures. People are going to be gobbling up on it's just not going to happen. So housing forecast, where are we going to be, guys? Still low digit, single digit appreciation. And let's analyze that. If we were up 15% for the year and we dropped 5, we're still up 10% year over year. Okay. Now we all know those people at the peak paid a lot more over asking. And that was because they could afford it. Let's just face it. Everyone that bought a house a year ago over asking was putting a huge amount down because you weren't accepting the offer unless it was like a ridiculous 50% down, 200,000 over asking, right? Those people are not going to walk away. They have skin in the game. So they may take a haircut on their values, but still year over year, we're in a really good position. Inventory will continue to tighten as builder sentiments and starts slow down. We saw the cyclical market and how it always works every year. So inventory, when there's low inventory, values still stay strong. Rents, unfortunately, will continue to rise. They're up 13% on new and 8% up on renewals to this date, year to date, right now. That's going to push people to buy. So if rates come down and there's less inventory and a lot of people need homes, what's going to happen next year? If rates come down and there's a lot of people on the sideline, what's going to happen when rates drop? Be ready, guys. Be ready. Now, here's a real estate report card. These are really great. I can send them to you. They're nationally. Guys, if you're in any state, this is a really great thing to look at. It proves what all of the factors go into your local market. This is New Mexico, local market, as far as values, the employment rates, affordability index, household formations in your neighborhood, what's happening. It's a really, really great, it's great data to share with your customers. Here's another format with us co-branding these. And it's great, guys. Great information. Knowledge is power, and your best opportunities lie ahead. Check this quote out. Charles Duell, head of the U.S. Patent Office, said this, and this is back in the day, in 1899. He said, we want to close the patent office because everything that can be invented has already been invented. So that's short-sightedness, guys. We cannot be short-sighted on this market. We have to look at the facts, look at the fact that we have a lot of humans that need households, and builders are continuing to slow down. And when rates drop, there will be huge opportunities coming soon. So what motivates you? Hopefully this motivates you guys to get out there and be a farmer. Plant seeds now for harvest this spring. Farmers spend a lot of money making zero profit during the initial stage of their cycle. So this is the time where you need to get out there and harvest. Plant your seeds, call your database. Don't spend your time on all of these expensive lead generation things when you're talking to people that are talking to 50 other people that don't know you. People are going to go with who they know and trust. Feed your current sphere, the people you know, the people around your neighborhood. Make sure you're working with the people you know and spread that you want to do business with them. Be a farmer of the people that you know and love, and get out there now, because you will reap the benefits this spring. And that's my little breakdown. I hope you guys enjoyed my Monday morning mortgage message. And I work nationally, guys, every state except New York and Hawaii. So if you have any mortgage needs, we are a mortgage banker, a mortgage broker, and we have a banking partner that has portfolio loan products that will blow your mind. We literally have everything from single wide homes to construction loans on super mega jumbo. We've got everything in between: Fannie, Freddie, Ginnie, VA, FHA, conventional, jumbo, everything, guys. So my 23 years in the industry, use it. I can be an asset to you and your buyers. And let's make this next year and the year end a successful one. So have a great one, guys. Love you guys, and stay positive, because it's going to be good. Talk to you guys soon.